You see a perfect support level. The price drops, creates a massive wick, and you immediately hit buy, thinking it is a textbook rejection. But seconds later, the market violently crashes, destroying your stop loss before rocketing upwards without you. Sound familiar? That wick was not a rejection. It was a highly calculated institutional trap. In this masterclass, I will show you how to decode the true story of wicks and bodies to uncover trapped volume and stop losing your capital. Let us begin by completely destroying the vocabulary you were taught in basic trading courses. If you read a traditional retail trading book, it will tell you that a wick simply represents a price level that the market rejected. The book paints a picture of a natural bounce, as if the price hit an invisible concrete ceiling or floor, realized it was not supposed to be there, and politely turned around. This innocent, simplified view of the market is exactly why 95% of retail traders lose their money. The financial market is not a natural environment. It is a highly engineered, predatory ecosystem dominated by massive banking cartels, hedge funds, and algorithmic high-frequency trading bots. These entities do not simply reject prices, they hunt for liquidity. When you see a massive long wick on a candlestick, you are not looking at a natural bounce. You are looking at a brutal, calculated financial assassination. You are looking at the visual evidence of trapped volume. Consider the fundamental mechanics of order flow. For a wick to form, the price absolutely had to travel to that extreme level in real time. It did not teleport. It had to aggressively push into that zone. During the formation of a long bottom wick, the candlestick was, at one point, a massive, solid red block of downward momentum. Thousands of retail breakout traders saw that red momentum and blindly pressed the sell button, thinking the market was crashing. Simultaneously, the retail buyers who were already in the market had their stop-loss orders resting at that exact extreme level. When the price hit those stops, it triggered massive automated sell orders. In that brief moment, the market is flooded with retail sell orders. This is the exact trap. The institutional algorithms, which need to buy massive amounts of currency without causing slippage, gladly absorb every single one of those panicked retail sell orders. They buy millions of lots at a massive discount. Once their massive buy orders are filled, there is no more supply left. The price aggressively shoots back up, leaving the trapped retail sellers completely stranded in deep drawdown. When the candle finally closes, all that remains on the chart is a long wick. Retail traders call it a rejection. Institutional traders call it a successful liquidity sweep. If you continue to trade wicks simply as bounces without understanding the trapped volume behind them, you will forever be the liquidity for someone else's trade. To break free from this, we must dissect the candlestick into its core physical components. To successfully trade these institutional liquidity sweeps, you need flawless execution. When the market creates a massive wick to trap retail volume, the price reverses violently in milliseconds. If you are using a low-quality broker, you will suffer massive slippage, platform freezes, and terrible requotes that completely ruin your entry point. That is exactly why I exclusively trade with XM Broker. XM provides institutional-grade liquidity, meaning when you click buy at the bottom of a liquidity sweep, your order is executed instantly with absolutely zero requotes. Click the link in the description to open an XM account and trade with professional precision today. To accurately read the true story of a candlestick, we must separate it into two distinct languages, the language of the body and the language of the wick. Let us decode the body first. In the pure physics of order flow, the candlestick body represents committed institutional mass. It represents true, undisputed value. The opening price and the closing price are the only two levels that the market formally agreed upon at the end of the time period. If a 4-hour candlestick closes with an incredibly large, thick, solid green body and practically no wicks on either side, it tells a very specific, undeniable story. It means that for exactly 240 minutes, the buyers had absolute undisputed control. They were not just probing higher prices, they were willing to spend massive amounts of capital to secure and hold that higher valuation until the clock ran out. Retail traders do not have the financial capacity to paint a massive solid body on a high time frame chart. It requires hundreds of millions of dollars of sustained buying pressure. Therefore, a massive body is an institutional footprint. It is the undeniable evidence of smart money sponsorship. When you see a series of large, healthy bodies moving in one direction, you are witnessing an established institutional trend. The market is happily discovering new prices, and volume is heavily supporting the move. The body is the truth. However, you must be hyper-aware of when the bodies begin to change. If you are in a massive uptrend characterized by large green bodies, and suddenly the bodies start getting smaller, thinner, and more compressed, you are witnessing the death of momentum. Even if the price is technically still making higher highs via long wicks, the shrinking bodies prove that the institutional commitment is fading. The heavy capital is stepping away from the market. Professional traders do not judge structural breaks based on wicks. They judge them based on bodies. If you buy at a support level and the price momentarily spikes below your level but closes back above it, your thesis is still valid. But if a massive, thick, solid red body closes completely underneath your support level, the structure is officially broken. The market has accepted the lower price. The institutional mass has shifted against you. You must always respect the body as the ultimate arbiter of truth. While the wick explores the extremes, the body anchors the reality. If the body is the truth and represents committed mass, the wick is the lie. It represents uncommitted exploration. But more accurately, it is the visual scar of liquidity engineering. Let us walk through the exact microscopic chronology of how a long wick is created during a major news event or a volatile session open. Assume the market is in a structural uptrend, but currently pulling back. Retail traders are eyeing a very obvious support line drawn perfectly across the recent lows. Phase 1. The liquidity trigger. The algorithms aggressively short the market, printing massive red candles that plunge directly through the obvious retail support line. Retail buyers who place their stop losses just beneath the line are instantly triggered out. Remember, a stop loss on a buy trade is an automated sell-to-market order. Concurrently, retail breakout traders see the support break and manually enter sell orders. The market is instantly flooded with immense sell-side liquidity. This burst of volume creates the absolute extreme tip of the wick. Phase 2. Institutional absorption. At the absolute low of this spike, the smart money steps in. They needed this massive pool of sell orders to fill their own massive buy limit orders. Because the retail traders are panic selling, the institutions can buy thousands of lots without pushing the price up prematurely. They completely absorb the retail selling pressure. Phase 3. Aggressive repricing. The moment the institutional buy orders are completely filled, the manufactured selling pressure completely evaporates. Because the massive buy volume now dramatically outweighs the depleted sell volume, the price rockets upward with extreme velocity. By the time the candlestick closes, the price is back above the support line, and the body closes green. What remains on the chart is a long, devastating wick extending far below the support line. This is why you must stop viewing wicks as mere rejections. That wick represents a literal bloodbath. It is a highly engineered trap designed to remove weak hands from the market and transfer their capital to the institutions. When you learn to read the charts this way, your entire trading psychology changes. Instead of placing your stop loss exactly where the textbook tells you to, you start anticipating the stop hunt. You wait for the massive wick to form first. You let the retail traders get slaughtered. You wait for the price to recover and close back inside the structure, and only then do you enter your trade alongside the institutional algorithms. You start trading the manipulation instead of falling victim to it. Let us apply this theory to past market data to see exactly how these traps unfold in the real world. Our first case study focuses on the inducement wick, which is one of the most powerful liquidity generation models used by smart money. Imagine a scenario on the Euro-US dollar daily chart. The macro trend is heavily bearish. The price has been dropping consistently for weeks, creating lower lows and lower highs. However, recently, the market has entered a slow, choppy consolidation phase. Retail traders look at this sideways movement and start to believe the bottom is finally in. They draw a minor resistance line above the consolidation, anticipating a massive bullish reversal. Suddenly, during the London session, the daily candle violently surges upward. It breaks the resistance line by 40 or 50 pips. Retail traders instantly suffer from FOMO, the fear of missing out. They see the massive green movement, their indicators flash buy signals, and they immediately execute long positions, completely convinced a massive trend reversal has officially begun. But let us look at the macro context. If you zoom out, the price has just spiked directly into an untested, unmitigated daily supply zone that was created weeks ago during the original downward impulse. The institutions were not reversing the trend. They were simply waiting for the price to return to this premium level to sell at a better price. By intentionally driving the price up to break the minor resistance line, they induced the retail traders to buy the fake breakout. This generated the exact buy-side liquidity the institutions needed to execute their massive short positions. They sell heavily into the retail buying frenzy. Because the retail buying volume is no match for institutional selling volume, the upward momentum instantly hits a brick wall and dies. The daily candle collapses all the way back down. By the end of the New York session, it closes as a solid red body back inside the consolidation range. The resulting daily candlestick has a tiny red body and an enormous, massive top wick. This is the inducement wick. It successfully induced buyers to enter early, trapped their volume at the absolute high, and used their money to fuel the continuation of the macro downtrend. If you understand order flow, this chart is screaming the true narrative at you. The wick proves the sweep of liquidity and the trap. The body proves the settlement, confirming there is absolutely zero institutional acceptance of higher prices. This specific combination, a long wick sweeping external liquidity to the upside, paired with a solid body closing in the direction of the macro downtrend, is one of the highest probability continuation setups in the entire Forex market. It is a visual guarantee that the smart money is heavily short. Our second case study explores the opposite side of the spectrum, the exhaustion wick, which is almost always found at the end of massive euphoric trends. A perfect historical example of this frequently occurs on gold, or major indices like the Nasdaq, where emotional trading is at its peak. Picture a scenario where gold has been aggressively rocketing upwards for weeks. Financial news outlets are constantly talking about it, retail forums are buzzing with excitement, and greed is at an all-time high. The candlesticks have been massive, full-bodied green blocks pushing higher every single day. As the price approaches a major, historical macro resistance level on the weekly chart, a massive logistical problem arises. The institutional algorithms that bought at the very bottom weeks ago are now sitting in massive, life-changing profits. They want to exit the market and secure their cash, but they cannot simply click sell. If they dump billions of dollars of sell orders at once, the price will instantly crash, causing extreme slippage and ruining their own average exit price. They need a massive influx of fresh, uneducated buyers to step in, so the institutions have someone to sell their positions to. So, they engineer a buying climax. They initiate one final, violent, vertical push upward, intentionally breaking high above the macro resistance line. Retail traders see the breakout, their FOMO completely takes over, and they flood the market with buy orders at the absolute peak, convinced the price is going straight to the moon. This is where the distribution phase happens. The smart money quietly and systematically unloads their massive long positions, feeding their sell orders directly into the frenzied retail buying pressure. Once the smart money has completely exited their positions, taken their profit, and even opened new short positions, the artificial buying pressure completely evaporates. The structural foundation holding the price up is instantly gone. The heavy weight of gravity takes over, and the price violently collapses back below the resistance line, closing the daily session as a small red body. The visual result left on the chart is a devastatingly long top wick. This is the exhaustion wick. It physically proves that the upward momentum is entirely dead. The retail buyers at the tip of that wick are now completely trapped. They are holding heavy, rapidly increasing losses. Over the next few days, as the price continues to bleed lower, the psychological pain will become absolutely unbearable for those trapped buyers. They will be forced to close their long positions, which means they must sell. This wave of forced retail selling acts as the highly combustible fuel that accelerates the new, massive institutional downtrend. The wick was the trap, and the trapped retail volume became the engine for the macro reversal. You now understand the deep mechanics behind why wicks form, but you cannot blindly trade every single long wick you see on a chart. The market is full of random, high-frequency algorithmic noise. To filter out the noise and find the true institutional footprints, you must apply strict mathematics to the anatomy of the candlestick, paired with absolute location context. A candlestick has a total range, calculated from the absolute high of the top wick to the absolute low of the bottom wick. For a wick to be classified as a high-probability liquidity sweep rather than just random market noise, it must constitute a massive percentage of that total range. If a candlestick is 100 pips tall in total, and the bottom wick is only 10 or 15 pips long, that is not a liquidity sweep. That is simply normal market breathing. Trading that as a rejection will result in a loss, because the institutional mass has not significantly shifted. The professional standard is the 50% rule. For a wick to be considered valid evidence of trapped volume, the wick itself must make up at least 50% of the total length of the candlestick. Ideally, the highest probability setups feature wicks that are 70 to 80% of the entire candle's range. Think about the physics of a 70% wick. It means that the market spent a massive amount of time and energy aggressively pushing in one direction, only to be completely and violently repelled back to the starting point. The longer the wick relative to the body, the larger the pool of trapped volume, and the more aggressive the subsequent reversal will be. Furthermore, you must carefully analyze the body that sits on top of that long wick. If you have a massive bottom wick, but the body still closes bearish as a heavy red block, it indicates that while buyers stepped in, the sellers still maintained ultimate control of the closing price. The trap is incomplete, but if you have a massive 70% bottom wick, and the remaining 30% is a solid green body that closes near the absolute highs, you have perfect order flow alignment. The sellers were trapped, the liquidity was absorbed, and the buyers completely dominated the closing phase. However, even the most mathematically perfect candlestick is entirely useless if it prints in the middle of nowhere. Context is king. A massive wick floating in the middle of a consolidation range is just an inducement trap. You must only trade these wicks when they perfectly interact with a higher time frame structural level, such as a major daily demand zone, an institutional order block, or a key liquidity pool. The location validates the shape, and the shape confirms the location. The final step to mastering the true story of price rejection is learning how to safely enter the market. If you simply buy at the close of a daily candlestick with a massive bottom wick, your stop loss has to go all the way below the tip of that wick. On a daily chart, that could be a 100 or 200 pip stop loss, which completely destroys your mathematical risk-to-reward ratio. To solve this, professional traders use multi-timeframe blending, also known as fractal deconstruction, to validate the wick and snipe the entry with absolute precision. Because the market is fractal, A wick on a higher time frame is actually an entire structural trend on a lower time frame. Let us say you are looking at the 4-hour chart and you see a beautiful, long bottom wick rejecting a major daily demand zone. To the untrained eye, it is just a straight line drawn downwards and back upwards. But if you drop down to the 15-minute chart to look microscopically inside that exact same 4-hour wick, you will see an incredibly complex battle. The downward push of the 4-hour wick will look like a completely valid, aggressive downtrend on the 15-minute chart, making lower lows and lower highs. The absolute tip of the 4-hour wick corresponds to the final, exhaustive push of the 15-minute sellers as they sweep the lower time frame liquidity. Then, the sudden upward retraction of the 4-hour wick will appear on the 15-minute chart as a violent change of character, a massive structural shift where the price violently breaks the lower highs and begins a rapid uptrend. Understanding this multi-timeframe relationship is the ultimate secret to zero drawdown entries. When you identify a massive 70% wick rejecting a major higher timeframe support zone, you do not enter the trade immediately. Instead, you drop down to the execution timeframe, usually the 15-minute or the 5-minute chart. You visually watch the lower timeframe trend trap the retail sellers, and you enter the market the exact moment the 15-minute structure shifts bullish. You place your entry order at the newly formed lower timeframe unmitigated order block, and you place your stop loss just below the lower timeframe swing low. By validating the higher timeframe wick with a lower timeframe structural shift, you drastically reduce your risk. You are using the macro wick for narrative and direction, but you are using the micro timeframe for surgical execution. This allows you to risk 5 pips to capture a massive multi-day expansion. Let us summarize the masterclass. The market does not simply reject price, it actively engineers liquidity to trap retail capital. Stop reading candlesticks as simple shapes and start reading them as footprints of institutional order flow. The solid body is the undisputable evidence of committed institutional mass and true market value. The wick is the visual graveyard of trapped retail volume and stop-loss hunts. Never trade a wick that forms randomly in the void. Only execute when a massive liquidity sweep perfectly aligns with your higher time frame structural zones. Always demand that the wick constitutes at least 50% of the total candlestick range, and always verify the trap by dropping down to the lower time frames to confirm the structural shift. If you stop trading shapes and start trading the underlying physics of trapped volume, you will completely transform your trading consistency. If this deep dive changed your perspective on price action, hit the like button, subscribe to the channel, and ensure you check out XM Broker via the link in the description for professional-grade, zero requote execution. Master the Wicks, protect your capital, and I will see you in the next video.